Today, we will talk about capital structure. Capital structure is the specific mix of debt and equity that a company uses to finance its operations and growth. Equity capital comes from ownership shares in a company, while debt comes from bond issues or loans. Short-term debt is also considered part of the capital structure. Both debt and equity can be found on the balance sheet, and a company's assets are purchased with debt or equity. The debt-to-equity ratio provides insight into a company's borrowing practices and risk. Debt has tax advantages and allows companies to retain ownership, while equity allows outside investors to take partial ownership. Companies with high leverage ratios and aggressive capital structures often have higher growth rates. Savvy companies incorporate both debt and equity into their strategies, but investors can monitor a firm's capital structure by tracking the D/E ratio. Firms in different industries will use capital structures better suited to their type of business. Capital-intensive industries may utilize more debt, while labor-intensive or service-oriented firms may prioritize equity. Managers decide on capital structure to minimize costs and risks, and analysts and investors use the D/E ratio to evaluate a company's level of risk and borrowing practices. There is no magic ratio of debt to equity for optimal capital structure, as it varies depending on the industry, stage of development, and other factors. Analysts and investors use metrics like the weighted average cost of capital to estimate the suitability of a company's capital structure. Here are 4 key takeaways. 1. Capital structure is how a company funds its overall operations and growth. 2. Debt consists of borrowed money that is due back to the lender, commonly with interest expense. 3. Equity consists of ownership rights in the company, without the need to pay back any investment. 4. The debt-to-equity D/E ratio is useful in determining the riskiness of a company's borrowing practices. Hope this would help. Thanks for watching.